we will discuss about one of the most interesting and one of the most amazing topic, and that is the methods of measuring national income. It is one of the most beneficial concept for the measurement, and it is one of the most important topic regarding your examination point of view. So generally there are three methods of measuring national income. First is product method, second one is your income method, and number third is your expenditure method. We will discuss them one by one. So firstly, we will discuss about the product method. In this method, there are two approaches. First one is your final product approach, and second one is your value added approach. Under the final product approach, it is expressed as gross domestic product. According to the final product approach, the sum total of market value of all final goods and services produced by all productive unit in the domestic territory of an economy in an accounting year is estimated by multiplying the gross product with the market price. It means that GDP is multiplied by the GDP at market price. Being gross, it includes depreciation. Being at market price, it includes net indirect taxes, and being domestic, it includes production unit within the domestic territory of a country. It includes final goods and services. Then second approach is value added approach. This method measures contribution of each producing enterprises to production in the domestic territory of a country in an accounting year. According to this method, net value added at factor cost by all the producing unit during an accounting year within the domestic territory is summed up. This gives us the value of net domestic product at factor cost or domestic income. Now the second method is income method. Income method measures national income from the side of payment made to the primary factor of production for their productive services in an accounting year. Thus, according to income method, national income is calculated by summing up the factor incomes of all normal residents of a country earned within the and outside the country during a period of 1 year, and income generated is nothing but the net value added by factor cost by factors of production, which is distributed in the form of money among them. Thus, if factor incomes of all producing units generated within the domestic territory are added up, the resulting total will be domestic income or net domestic product at factor cost. By adding net factor income from abroad to domestic income, we get net national product at factor cost. GNP is the addition of all factor income generated in production of goods and services. While measuring GDP, we must include only those income flows that originated with the production of the goods and services within the particular time period. The components of factor incomes are implies compensation, number second is profit, rent, interest, mixed income, and royalty. Profit, rent, interest, and other income are jointly known as operating surplus. Thus, national income is equals to compensation of employee plus operating surplus. Next is our expenditure method. National income can be measured by taking into account of all final expenditure in the economy. There are three distinct types of expenditure as they are committed by the household, firms, and the government respectively. These expenditures are classified in following types. First is private consumption expenditure, government expenditure, government purchase of goods and services, investment expenditure, and export, that is export minus import. Thus, GDP is equals to C plus I plus G plus X minus M. Thank you.